So, hope everybody can hear me okay. Got a new little intro going on, so I hope you like that. I'm actually not sure if it worked correctly, so still figuring things out. Remember, I am a trader. I am not a professional presenter or media specialist, so keep that in mind. Anyway, let's jump into Navigation Trading Live. First off, congratulations to last week's winner of our Name That Puppy contest. Congrats to Maria. Our new puppy's name is Vix, for those of you who didn't catch that. So remember, we're gonna do this every week where we have this trivia contest, and it's the first listener to answer correctly wins. I want to engage you guys. I want to get you engaged and watching this live. And so if you're watching it live, you're going to have a better chance of winning than if you watch the recording, which is posted directly after. So the first listener to answer correctly wins. And secondly, don't forget, I had some people email me answers. Do not email me. They will not count. Your answers must be posted in the comments section on our Facebook page or YouTube, right below the video. So trying to get more engagement on Facebook and YouTube, so make sure you use those channels. Before we do this week's trivia contest question, I was in Chicago last weekend, Thursday, Friday, and Saturday, and I visited the Chicago Board of Options Exchange. If you are ever in Chicago, I'd highly suggest setting up a tour of the CBOE. It was really cool to see some of the history and just some of the behind the scenes workings of how the Chicago Board of Options Exchange works. And it's kind of interesting. So here's the bell that used to be rung every morning when the market's open. Now it's just more of a symbolic bell now. They'll still have people come in for different reasons to ring it. Many past presidents and other celebrities have rung the bell in the past. And what's interesting is I got this picture because it's overlooking the VIX pit. Okay, this was on Friday, May 5th. And look, there's a few people down in the pit, a lot of computers. Everybody's really calm and collected. And what's interesting is back in 1989, this was the OEX pit. So this same pit that we're looking at here from Friday is the exact same pit that you see, and this is what it looked like in 1989. And at that time, it was the OEX pit. There were hundreds of traders in there. People were going crazy, fighting for order flow and tickets and things like that. And today, it's not as exciting, but it was exciting. It was interesting to see how some of the operations went. There's still a lot of like hand signals and things going on to get orders filled. But for the most part, it's an electronic market now. There's still a little bit of open outcry in certain markets like SPX and some of the commodities and things like that. But it's largely all electronic now. But still interesting, still worth your time if you're in Chicago. Go take a visit to the CBOE. So along those lines, regarding this week's trivia question, one of the individuals that was kind of guiding us through, they were pointing out some history, and then they were also telling some different significant things about trading in general. And one of them was they started talking about put skew. And so here's this week's trivia question. First of all, what is put skew? And second, what year did it begin and why? Okay, so this is kind of a three-part question, and it's going to be the most accurate answer and most complete answer is going to win this week's trivia prize. And the prize is you get to choose any course that you want from NavigationTrading.com. And all you got to do is post it there on Facebook or YouTube if I announce you as the winner. And keep in mind, this is a little bit of a subjective answer, And I am the final ruling, so I don't want anybody whining and complaining if they think their answer was better, but I chose somebody else. So what is put skew? What year did it begin? And why did it begin? Why does put skew exist? Okay. So a couple announcements. Same thing we've been talking about here for a couple weeks, but new course coming out next week. Our navigation strategy ebook and hard copy book in final editing mode. Hope to have that here in the next couple weeks. And the new lower commission rates coming soon, I promise. I know everybody's anxiously awaiting. I see your emails, I see your comments. I know we are just as frustrated about the delay and getting this done for you guys as ever. So we're pushing. We're hoping it's a couple weeks away. This is what we keep being told. So it's a little bit out of our control, but we're working on it and we're pushing for you guys. So stay tuned. And remember, this is all about you. So if you have any topics or suggestions or things you want us to cover on Navigation Trading Live, let us know and we'll do our best to get it worked into the broadcast. So the topic of the week that I want to talk about, because this is something that we've really been working a lot on, spending a lot of time on back testing and in reviewing other studies about this. And the topic is managing strangles early. Okay, so if you're an alert subscriber, you know one of our favorite strategies to implement or to use for selling premium is strangles, right? You're selling an out of the money put, you're selling an out of money call, and we call that a short strangle. So in my courses, you also know that we like to manage those at a percentage of max profit, right? We don't let them go all the way to expiration, but traditionally, and really, in years past in me trading, I would let those go, sometimes down to the week of expiration, or or maybe not quite that far, and thinking I was giving myself more time to be right, and that was going to be a more profitable way to do it. But in the studies I've shown, that we've run, and the studies that we've seen, what we're finding out is that the earlier that you close or roll the trade, the better. And so for you alert subscribers, and I'm going to put another video to add this into the course to make it part of a staple of our trading, and that is, we want to close or roll by the time that option gets to 21 days to expiration. So remember, we're putting these on with kind of 30 to 60 days to expiration, but we really want to be out of that expiration cycle when there's about 3 weeks left. And the reason is, and this is counterintuitive to what a lot of people might think, but the reason is because of what's called gamma. And gamma is one of the 4 main option Greeks when it comes to trading options and how the models are built and so forth. And so gamma is a measure of the amount of risk in the trade. And so what you need to understand is that the closer you get to expiration, the higher your gamma becomes. And what that means in a simplistic way is you don't get as much bang for your buck the closer you get to expiration. Now some people say, well, whoa, wait a minute. The theta increases, the most acceleration of the time decay happens in that last part, and that's all true. However, the amount of risk that you're taking compared to the reward that you get is significant in those last few weeks. And the closer you get to expiration, the more that risk and that acceleration happens, and the less valuable it is for you in that trade. Okay, so what I want to really hammer home is that with our trades, especially with our navigation alerts, so you subscribers, what you understand is that we're going to put these trades on closer to that 30, 40, 50, 60 days to expiration, but we're going to be out of that trade by 21 days. Now, that doesn't mean we have to be out of the position, but we are going to be either closing it out if we're profitable, or if we're not, we're going to be rolling that trade to the next expiration cycle. And keep in mind, when we get to that 21 days to expiration, well, guess how many days are left in the next expiration cycle? Typically about 45 to 50 days, right? Which is great, which is the optimal time frame we want to be entering trades anyway. So it all kind of ties together. It all makes sense. And what we found in these studies is that by doing this, it actually reduces our risk by 30%, and our returns are enhanced slightly. Okay, so we're getting the same to a little bit better returns on our money, and our risk is being reduced by 30%. Our gamma is being reduced by 30%, which is huge. I can't emphasize that enough, because of course we all want big returns, significant returns, but you've got to also pay attention to the risk side, and that's measured by gamma. And if we can smooth out that gamma, it'll smooth out our equity curve. We'll take our P&L will have a lot less of a roller coaster ride, a lot smoother returns to the upside, and that is what we want as traders. All right, so I hope that was helpful. Let's jump into this week's trade of the week. So let's go to the platform and take a look at what's going on in the markets. So let's just go over a few things first here. You see the stock indices. You've got the S&P down about 3.5, Dow down about 26, NASDAQ down 5. Remember, the Russell futures don't trade on the same exchange anymore, so there's some changes going on there. So you got to look at IWM or RUT to see what it's doing. IWM's down about 0.25%. Bonds down a little bit, notes down a little bit. You can see the VIX is down about 3.5, so it's trading around 10. VIX futures about 11.5. So very, just continue to stay low there. Oil is pretty flat on the day, but we've seen some implied volatility creep up in oil. We will come back to that because oil is going to be our trade of the week, one of my favorite trading vehicles. Gold's pretty flat. Silver down about 0.5%. Natural gas making a big move down. Let's take a look at natty gas. A little bit of about 2.75%. So not huge on a relative basis. Natural gas moves around quite a bit. Let's look at some of these other markets. All the grains down a little bit. Soybeans down 0.1%. Corn down 0.5%. Soybeans down almost 0.5%. Wheat down 1.25%. So big moves continue to happen in wheat. EWW, the Mexican ETF, down about 0.33%. The euro down. The French elections were finalized last night, for the most part, I believe, and so looks like the euro's down about 0.5%. So not much of a reaction there. I think with Macron winning, I think that's how you pronounce it. That was kind of the expected outcome, so not much of a change there. EEM up 0.33%, EFA down, EWZ, the Brazilian index, down 0.5%. Apple's up 0.5%. Some of these other stocks, Tesla's up about 1.5%. Amazon down 0.75%. Costco down almost 5%. Goldman looks like the bank's pretty flat. XBI, Baidu, nothing else really too significant here. Just kind of scanning here. Okay, so let's go back to oil. So remember, we are always looking to sell high implied volatility, but implied volatility is relatively low across the board. I mean, if you look at the S&P 500, IV percentile and IV rank at 7 and 8 respectively. If you look at the VIX, which we already mentioned, the VIX is trading at extreme lows, right around 10 there. So we have to we can either start doing a bunch of calendars, but in this case, what I want to do is take a look at oil. And so remember that kind of that mark that we want to look at to think about high implied volatility is that 50 level, right? We want implied volatility, either IV percentile or IV rank, to be over 50. But what if there's nothing over 50, right? You can still be profitable selling premium when implied volatility, IV rank and IV percentile are under that 50 mark, you're just getting more premium and a higher percentage of chance of success the higher, as it goes above 50. But this is the highest thing on the board, guys. So I don't really have an issue. I mean, it's at 43 on the IV percentile. So we're splitting hairs. What's the difference between 43 and 50? It's not too much. So, I like to keep that 50 as a guide, as a baseline. But if there's nothing else out there to do, you've got to stay engaged. We don't have, on the alerts, we don't have an oil position on. So I'm going to sell some premium in oil. And since we're talking about strangles, I'm going to go ahead and sell a strangle in oil. So as we typically do, we want to be kind of between that 15 and 20 delta. Let's just choose and I like to use round numbers on oil as opposed to the half point strikes. So let's go with the 51, which is a 21 delta. You could use the 16, which is the 52. So if we want to get, and in fact, because implied volatility is lower, I will go a little bit wider. So I will opt for the 52 strike, which is the 16 delta versus the 51. And then on the put side, you can see the 42 is the 16. So we've got 16 delta on both sides. Standard one, that's a 1 standard deviation strangle. So let's go ahead and get that on. Sell, strangle. So it populates our calls. So now we got to come up here and put in our puts, which is the 42. And then once I get off here, I will get that filled. So I'm not going to get it filled on air here because I'll get this filled and then I'll send this out to our alert subscribers. But if we take a look here, collecting a credit of $880 or 88 cents in option terms on the oil. Remember, these are a little bit different as far as the multiple. 88 cents on a traditional equity option would be $88, but in this case, in oil, 88 cents means $880, and you can see that by looking at your max profit here. Okay, so you get some really nice premium when you're trading options on futures, which is one of the reasons I really like to do it. So that's our trade of the week. I'm gonna get off here and go send this out to our alert subscribers, get us filled. But don't forget about the trivia contest. Answer on Facebook and YouTube. What is put skew? And what year did it begin and why? So most complete answer wins. Good luck, everybody. Have a great week of trading. Talk to you soon.